Hello friends, welcome to this video. I have been getting many requests from students across the country asking me to explain this illustration 19 of the chapter investment decisions, that is capital budgeting, based on the concept of adjusted present value. Now in this video I'll just explain to you what this question is all about, what the concept is all about. There are total 2 points that we need to discuss. The third one is a very simple theory point which you can read on your own, but the first two is where students are finding problems. Now before I go ahead, I would also want to tell you that the new syllabus which has come out for May 2024 onwards, in that syllabus this particular illustration and this particular concept of adjusted present value has been deleted, which means it is no longer a part of your syllabus. Yes, this question was once asked in May 2018, but since then it has never been asked. So I might feel that the last attempt for which this question could be of use is November 2023, but still there is no guarantee, it can come in the future also, but it was my responsibility to tell you that May 24 study module does not have this illustration or the concept as a whole. Okay, so now let us try understanding what adjusted present value is through this particular question. Now they are saying XYZ Limited is presently an all equity financed company, okay, which means this company completely runs on equity financing. There is no debt, which means here the cost of capital which will be used for discounting future cash flows to find the NPV, can I say, will be KE, because there is no KD and therefore no point in calculating KO, because the KO and KE will be same only. The directors of the company have been evaluating investment in a project that will require 270 lakh capital expenditure on new machinery. So students, basically there is a project which is being evaluated, and in that project, do you realize that the initial investment that is required, okay, the initial investment that is required is how much? 270 lakhs. Everyone clear till here? Next, they expect the investment to provide annual cash flows after tax, which is called as CFAT in our capital budgeting language, cash flows after tax, of 42 lakhs indefinitely. Now indefinitely, what do you mean by indefinitely? Can I say indefinitely means there is no life, every year for eternity, for perpetuity, you will keep getting 42 lakh rupees. And the discounting rate which is applicable to such investments is 14%. Now students, this 14% do you realize must be KE, correct? So I'll write here, cash inflows are equal to 42 lakh per annum for eternity, correct? And the discounting rate which is given to you is 14%. Now if I had to calculate NPV of this project without reading anything ahead, how would I have calculated NPV? Can I say NPV would have been present value of cash inflows minus present value of cash outflows. I am doing it without making a table here. So present value of cash inflows, can I say 42 lakh, since you are going to be getting every year for eternity, the present value will be 42 lakh divided by the rate, correct? That is 42 lakh divided by 14% will give you the present value of all future 42 lakh starting from end of year 1 till eternity, and then minus 270 lakh, can I say, into 1, because it is initial investment, discounting factor will be 1. So if we solve this, we will get 42 divided by 14%, okay, minus 270, we get 30 lakhs, okay. What we get is 30 lakhs as the NPV of this particular project if it was completely equity financed. Till your story clear? Great. Now moving on. They are saying that the directors of the company believe that the current capital structure fails to take advantage of tax benefits of debt. Okay, what does this mean? They are saying that the directors of the company feel that, hey, we are issuing equity for the entire project, the whole project is equity financed. If we would have taken debt instead of equity, then on that debt we would have had to pay interest, and that interest which we pay helps us save tax. Now in case of equity, we don't pay any interest, we pay dividends, and dividends don't save tax for the company. They are not allowable expenses. But in case of interest, as all of you know from the chapter cost of capital, interest saves tax for the company. Can I say because of equity financing, or I might say all equity financing, the company is losing out on the tax savings by interest. Everybody clear? So they are now proposing to finance the project with perpetual debt. Okay, the project is of course perpetual, right? Till eternity you are going to be getting money. So they are saying instead of raising equity for the same, let us raise debt for the same, perpetual debt secured on the company's assets, irrelevant point, basically secured loans. Okay, the company intends to issue debt to cover the cost of capital expenditure and the after tax cost of issue. So basically what they are saying is that we will be issuing debt. How much debt we will be issuing? Whatever is the initial investment required for this particular project, that much debt we will raise. And also if there is going to be any cost of issue, now cost of issue could mean flotation costs, right? Initial costs, preliminary expenses of raising money through debt, that much portion also we will raise through debt only. They are saying the current annual gross rate of interest required by the market on debt of similar risk is 10%. So this, can I say, is like the interest rate given to you. The after tax cost of issues are expected to be 10 lakhs. Okay, which means the initial expenditure, the preliminary expenditure that you need to do for raising money through debt is going to be 10 lakhs. Therefore, do you realize the total amount of debt that you will be raising is 280 lakhs, because 270 lakhs you will require for the capital expenditure and further 10 lakh you will be requiring for the initial expenses, right? The company's tax rate is 30%. You are required to, point number 1, calculate the adjusted present value of the investment. Now, I'll first of all tell you what is the formula of adjusted present value, then I'll explain to you the logic, okay? See, they are saying that adjusted present value is equal to base NPV minus issue costs plus tax savings by interest. Okay, base NPV minus issue cost plus tax savings by interest. Of course, everything has to be in present value terms, right? Because we are finding the present value, right? So now what is all of this? First of all, I want to tell you that the base NPV that they are telling or they are talking about in this formula is nothing but the NPV we just calculated, which means what we calculated here, calculation of base NPV, base NPV. So what is the definition of base NPV? The definition of base NPV is the NPV that you will earn if the project is all equity financed. I'll again repeat, base NPV is the NPV that the company will earn if the project is all equity financed. So therefore, I will write here below base NPV as 30 lakhs. Now, what is the concept of adjusted NPV? Adjusted NPV says that okay, you first of all calculate the NPV as if the project was equity financed, that means you calculate base NPV, and then adjust for all those differentials which will happen in cash flows due to raising money through debt. So basically, if you are raising money through equity, okay, this is the NPV. Now if you are raising money through debt, do you realize the project is not going to change? Everything will remain same only. Yes, there could be some plus minus that will happen because of the introduction of debt. Only that plus minus you adjust to this 30 lakhs and you get the adjusted NPV. So basically, some of you might think, why not recalculate the whole NPV without taking equity into picture? Just think from start only that we had taken debt and then accordingly calculate the NPV. You are right, you can do that. Adjusted NPV is saying we don't want to go through that route. We want to go through a route where we first of all calculate a simple NPV assuming all equity financing, and then we will adjust it for all those plus minuses that will happen if instead of equity we are going to go for debt. Now students, there are going to be only two adjustments. One, if you are going to be raising money through debt, then there is going to be an issue cost. That issue cost is not there when you are raising money through equity, supposedly as per this particular concept. That is the issue cost only of debentures. You must have studied in your earlier years cost of issue of debentures, right? So that cost of issue of debentures, can I say, will come only if you raise money through debt, and therefore do you realize that this 30 lakh, which is the NPV which you have earned by all equity financing, can I say, will further reduce if you raise money through debt because of the cost of issue of debentures, the flotation cost, the initial cost, which turn out to be 10 lakhs. So therefore do you realize that your base NPV, which was 30 lakhs, will get reduced by 10 lakhs. Everyone clear till here? Moving on. Then the last part, tax savings by interest. Now let me explain this. First of all, some of you might think, sir, there is one more added cost, right, which will come because of raising money through debt. Which is that cost? The interest cost. I will say no, that is not an additional cost, or I might say that is not an additional cash outflow, because if you raise money through equity, there is a dividend that you have to pay. So if you raise money through equity, dividend you have to pay. If you raise money through debt, interest you have to pay. So as far as these outflows are concerned, can I say it is common in both and should not therefore be taken into consideration while calculating the differentials for adjustment. The only, however, point of difference would be that if you would have raised money through equity, which means the 30 lakh base NPV that we are calculating, from that basically if dividends had to be paid, can I say those dividends wouldn't have saved tax for you. But in case of debt financing, equivalent interest you will have to pay, but on that interest, can I say, you will be saving tax. Everybody clear? You will be saving tax, and those tax savings, do you realize, will add on to the net present value, because this particular 30 lakhs that we have calculated, can I say, is assuming that there are no tax savings due to interest, and we must have shown a big hefty tax while calculating this 42 lakh rupees CFAT. But if there is a tax saving that will happen in the company due to interest, do you realize the final answer will slightly swell up? It will swell up by exactly the tax saved by interest. Now students, how do I calculate the tax saved by interest? Very simple. The total debt, as we had discussed, was 270 lakh plus 10 lakh. So I'll write here 270 lakh was the debt we raised for the project, and 10 lakh is the debt we raised for the issue cost. So can I say total of 280 lakh rupees debt we have raised. On this 280 lakh rupees debt, can I say there is a 10% interest. So can I say this is the interest per annum, and on this per annum interest, do you realize you will be saving a 30% tax rate? Everyone clear? You will be saving 30%. Now this saving that you see, can I say, is going to happen not only for 1 year, but it will happen for perpetual years, eternity, indefinitely, and therefore for present value, do you realize we will have to discount it by the discounting rate? Everybody clear? We'll have to discount it by the discounting rate. Same type of calculation, right? Present value of perpetual annuity. Just divide by the discounting rate. Now students, what discounting rate to take? Do you realize now we cannot take this 14%? Why? We cannot take this 14% because that 14% now will no longer hold true, because the financing is changing. It is no longer KE now. Everyone clear? We are going for debt financing. So this goes out of the picture. Next rate that we have, can I say, is the interest rate and the tax savings. Now students, here it is said that we should take the interest rate. Everybody clear? We should take the interest rate as the discounting rate. Now here comes a question or a debatable point that, okay, we understood we should not take 14%, that is the KE, we should come to KD. But sir, KD, can I say, is interest rate into 1 minus T, correct? Interest rate into 1 minus T, 10% into 1 minus 0.3. Sir, the discounting rate should be 7%. Okay, I agree with you, but I want you to focus hard on this part here and tell me, what are you discounting? Can I say we are discounting the tax savings? correct? We are discounting the tax savings. We are taking tax savings in the cash flows. We are saying, hey, these are the extra cash flows we will be getting due to tax savings. Can I say if those same tax savings I consider in the discounting rate also and thereby reduce the discounting rate, do you realize a reduction in discounting rate will increase the present value? Do you realize there will be double calculation of tax saving? One, you are already taking the tax savings as cash flow, and then you are discounting it also by a rate in which you are again taking the tax savings into consideration, which is why students there will be a double addition of the present value of tax savings which we should ignore, which is why we should take a normal interest rate here, that is 10%. Okay, so 10% here therefore becomes the discounting rate for discounting the tax savings, okay, caused by interest. Simple question. You are basically asking me, sir, why are you not taking tax savings into consideration? 1 minus 0.3 you should do, no? I am saying look above, that is exactly what you are taking into consideration, right? That is what we are discounting here, right? Okay, so if I take my calculator here, this will be 280 lakhs, okay? I guess the 10% will get cancelled off, and into 30% if we do, that is 84 lakh. So this is 30 lakh minus 10 lakh. And I hope you realize this is 10 lakh into 1. Why 10 lakh into 1? Because initial cost, issue cost, correct, discounting factor here 0 will be 1, and this is plus 84 lakh. So if we solve this, you will get 30 minus 10 plus 84, and that comes to 104 lakh. Okay, so 104 lakh therefore becomes the adjusted present value of this particular company or this particular project, I might say. Now coming to point number 2, okay, the last point of discussion in this particular video, calculate the adjusted discounting rate. Now students, the adjusted discounting rate, this particular term when you see, one thing that might crop up in your head is the chapter of capital budgeting and risk analysis which is there in Inter CA FM up till November 2023. After that it is deleted. And in that we had this concept called as risk adjusted discounting rate, and this seems so. Adjusted discounting rate might be risk adjusted discounting rate, but institute has other plans. It is not referring to RADR, it is referring to something else. So I'll tell you what adjusted discounting rate is. Students, adjusted discounting rate is basically at what rate you should be earning cash inflows so that adjusted present value becomes 0. Okay, I'll again repeat. Adjusted discounting rate is the rate at which you should be earning cash inflows so that adjusted present value becomes 0. So I'll write here point number 2. Let annual cash inflow be X. You will understand everything when I am doing the solution. Now please pay attention. Let annual cash inflow be X so that adjusted present value is equal to 0. Till your story clear? Okay. It's like IRR, right? But IRR makes normal NPV 0. Now we are going for adjusted PV to be 0. For that, how much should be the cash inflow, right? So do you realize adjusted present value is equal to, what is the adjusted present value? Tell me. It is the base NPV minus the issue cost present value plus the tax saved by interest, correct? Tax saved by interest present value. Now you want this to be 0. Do you agree? Now as far as base NPV is concerned, it is 30 lakhs. How did we get 30 lakhs? 42 lakh divided by 14% minus 270, right? So we had done 42 lakh divided by 14% minus 270, correct? That was the base NPV. But now we don't want this 42 lakh, right? We are searching for what should be instead of that 42 lakh. Because if we take 42 lakh, you know that the adjusted PV is coming to 104 lakh. Now I want the adjusted PV to be 0 lakhs or basically 0, correct? And for that, what should be the annual cash inflow? That is what we are calculating, okay? And initial cost of course is 10 lakhs and tax saved by interest, as you can see, is 84 lakh, the present value, right? Okay. So if we solve this, this is 0 is equal to x upon, I might say 0.14. Now minus 270, okay, so I'll just write here minus 270, okay, minus 10 plus 84, and this comes to minus 196. So can I say 196 is equal to x upon 0.14? Therefore x comes to 196 into 0.14, okay, 196 into 0.14, which is equal to 27.44 lakhs. Now what is the meaning of 27.44 lakh? It means that your annual cash flows, if are 27.44 lakh instead of 42 lakh, can I say your adjusted present value will become 0. So then sir, what is the rate that they are asking, adjusted discount rate, what is that? Now I will tell you. Can I say therefore the adjusted discount rate should be 27.44 lakh is what you should earn every year. The investment that you have done, can I say is 280 lakh, of course including the issue cost, right? 270 is for the project plus 10 you are incurring extra, right, for issuing the debt, into 100 if we do, that is the adjusted discounting rate. So 27.44 divided by 280 into 100, and that comes to 9.8%. Okay, 9.8%. So this is as far as your point number 2 of this question is concerned. Students, now we got first answer as 104 lakh. Let us see what ICAI has got. Okay, after doing all of this, very good, they have got 104 lakhs. Next students, the second answer we got is 9.8%. Let's see what ICAI has got. Oh my god, they have got something else. They have got 8.8%. Now why is that? It is because they did everything correctly. Yes, they were calculating the income to make NPV 0, let annual income be X, everything was correct. But by mistake, instead of taking 84 lakh, they by mistake took 104 lakh. Okay, so instead of taking 84 lakh, they took 104 lakh. Students, do you realize everything else is same? 280, 0.14, you can see here. I'll show it to you. 280, then 0.14. Now this 84, they pasted it here as minus 84. Okay, no problem. It should be minus 84 there. But instead of minus 84, they wrote minus 104, and therefore the solution slightly changed. So it's a printing mistake, I might say, and hence according to me 9.8% is the correct answer. Everyone clear? And then at the end they are asking you basically that explain the circumstances under which this rate may be used. Students, this rate, which rate? This particular rate, under which circumstances it may be used? Very simple. If the further projects are of the same risk as this project, simple answer. If the further projects are of the same risk as this project, then you can continue using this rate. Also, of course, in those projects, the financing has to be done through debt. That is what they're telling you in this particular point, that is point number 3. Right. So with that, students, we complete the discussion to this question that has been troubling you since long. I hope I was able to make things clear for you. Thank you very much and all the best for your exams.